Lecture 10: Reversal Signals, Exhaustion Bars, and Climax. In this lecture, you will learn about exhaustion bars and climax. So before explaining what exhaustion and climax are, I want to begin this lecture with an example or a trading situation that will help you understand these reversal signals. Can you remember a situation when you were holding a losing trade in hope that the market will soon reverse and let you close your trade, but the market kept going to a point that you no longer could bear the pain, and you decided to close your position? And exactly at this point, when you have just closed your position, the market suddenly reverses. It looked like that the market was just waiting for you to close your trade before going to the opposite direction. And this left you confused because the price action just before you closed your position was showing strong continuation bars. Similar situation is illustrated in this Euro USD chart. In the present price action, you can recognize a nearly perfect double top reversal pattern, and suppose that you have decided to enter the market early here when the second top was rejected. And I have said the word early because typically it is dangerous to enter a double top pattern near the resistance level. But let's suppose that you were so confident that you decided to take this trade. And for you, it seemed to be a good and profitable setup, unless that there was no follow through and that the market went up, resuming the uptrend. You are currently holding a losing trade, but you have decided to wait for the market to turn down because you believed that the market will reverse the trend. Until this happened, where a strong bull trend bar just appeared, showing that the market is ready to resume the uptrend and indicating that there is a strong buying pressure. This situation made you nervous, and you decided to cut your loss and to close your trade. Just after the position was closed, the market immediately reversed to the downside. It turns out that the last move up was not due to high buying pressure. In fact, it was just due to a selling gap or a vacuum where sellers paused their selling until the price reaches certain level, which was here around 1.1355. Whatever the importance of this level was, smart pairs were certain that the price will reach that level, and it was meaningless for them to sell below it when they can have a better price to sell from. The lack of sellers pulled the price up and created an exhaustion bar at the end of the ongoing trend that trapped buyers in and trapped sellers out by forcing them to close their positions. Hopefully, at the end of this lecture, you will be able to explain why the market behaved just like that. And most importantly, you will learn how to avoid such situation in your future trading. So what is a climax? A move in the price can be described as a climax when the move has gone too far too fast. A climax can be considered a signal for reversal if it immediately reverses direction to either a trading range or an opposite trend. And what is exhaustion bar? An exhaustion bar is an unusually large trend bar in the direction of the trend, and it often represents an emotional exhaustion of a trend. Exhaustion bar is common at the end of most trends that showed decrease in momentum. Therefore, an exhaustion bar is kind of fake breakout that is trapping traders near the end of the trend. This chart is showing a typical climax and exhaustion bars here. This uptrend has lost its momentum as it is confirmed here by the range trading zone. And it seems it is ready either to resume its way up or to reverse down. Many traders put their buy stops just above the range in a hope to catch a breakout to the upside. Those buyers were trapped by this exhaustion bar that broke the range to the upside and then quickly reversed down to the range trading again, making a failed breakout from the range. This is typical trap because, as you remember, my golden rule is that most breakouts fail, especially if it is the first attempt to break. 90% of the first attempts of breakout fail. Again here the market used an exhaustion setup to trap the buyers in and to trap the sellers out. Sellers would be afraid to sell after seeing this large bull bar, and buyers would be tempted by this strong bull bar and they would initiate new long trades, hoping for a follow through to the upside. Unfortunately, as it turned out, both of them were wrong. Their actions were emotional and based on fear for pairs and based on greed for bulls. On the other hand, experienced bulls and bears were stepping aside. After the exhaustion setup was clear, sellers then come into the market and sell heavily because they see this move as a climactic end of the uptrend. What happened here near the breakout to the downside is that bears re-established their shorts while trapped buyers have sold back, closed their longs, which added a pressure on the price to go one directional to the downside. These actions are very common near the end of every trend when the strong traders are waiting for the last strong trend bar before they act. This is especially true and expected near a strong support or resistance level. The price usually tries to break the resistance or the support line with a climactic bar that is soon reversed as the breakout fails. While many buyers and sellers have been trapped, always remember that it's very rare that the first attempt to break out succeeds. Most of the time it fails. This rule will help prevent you from being trapped by the market during a climactic move to break a strong resistance or support line. In fact, as you have seen here, a climactic breakout that is immediately reversed is a reliable signal for trend reversal to the opposite direction. This is the end of this lecture, and in the next lecture, I will discuss using trend lines as with trend signal, and you will learn how trend lines can be used in trading trend continuation or trend reversal setups.